on today's show, 3 questions. Number 1, is this the new normal? Number 2, are you living paycheck to paycheck? And number 3, how much do you actually need to save?
Consult an advisor or conduct your own due diligence when making financial decisions. General principles discussed during this program do not constitute personal advice. This program is furnished by Dentist Advisors, a registered investment advisor.
Welcome to Dennis Money's 2 Cents, where we help dentists navigate all the noise. I'm Matt.
I'm Jake.
And I'm Rabih.
Dream Team. Yo, sorry. Yeah, you are. Dream Team. Sorry, guys. We just got back from our company. Rabih, you call it a vacation. Is it a vacation?
For me, it's a vacation.
Jake, what do you call it?
A retreat is great. I think a company retreat. Retreat almost sounds nicer than a vacation. It kind of rest, relaxation kind of tones in there. I like it.
Yeah. Jake, Rabih was, I'm not going to say complaining. I'm not going to use that term, but he was critiquing the fact that we went a little bit long on our meeting. So for those of you, we'll give you some context here. We did this company retreat. We do this every year. The last 4 years, this is our 4th year doing it. We rent a big house down in St. George, Utah, and we just have a ton of fun. We do activities and just hang out as a whole team. It's really great. But we dedicate about an hour and a half, max 2 hours of the entire time, of the entire 4 days together for a little bit of work stuff. We just think it's always a good opportunity to come together, talk about culture, talk about, the summit coming up June 11th through the 13th. Be there, Midway, Utah, DennisMoneySummit.com. We just come together and talk about this stuff. And Jake, Rabih was saying maybe we did too much work down there. What say ye, Jake?
Yeah, we literally went, not even 2 hours?
Yeah, hour and a half-ish.
I think that was okay. I think that's an appropriate amount, Rabih.
Yeah.
And blame a guy for wanting to have fun. You can't blame me.
Rabih, you had plenty of fun, okay? You rock climbed, you went on an ATV ride, we were playing in the pool, you did some sand volleyball, e-biking up Zions. The e-biking in Zions was incredible. So we digress. We won't give a play-by-play of our entire retreat, but it was fun. We just got back yesterday, so we're dragging a little bit, I think, today. We're having a little bit of that retreat hangover.
There we go.
Let's jump in. Rabih, is this the new normal?
It might be. Simply because we're trying to look at how markets are reacting together. And honestly, the theme that we've been covering for the last 3 weeks, all-time highs, with just the same economy but higher oil prices, is still there. The only addition that happened this week is that the Federal Reserve has met. And
are you doing okay?
I'm doing great. Just because I was on a vacation, I couldn't really go into my morning stage, so we'll do it next week. But
Rabih came immediately down the stairs. We're like, did you guys see Jerome Powell's final press conference? We're like, you okay, Rabih? You doing okay?
I didn't watch it, but it seems like it was a good one. Here's just the important updates out of it. The important updates out of that one is that the Federal Reserve kept interest rates unchanged between 3.5 and 3.75. The decision was not unanimous. There's always Miran that wants lower interest rates as usual. But then there were 3 other members that they objected on the language that was used in the statement, because the language suggested that the central bank would eventually resume cutting rates. And the vote was 8-4 for keeping rates uncut. And this was the first time this has ever happened where the dissent was this big since October 1992. So it was big. But honestly, this was the last meeting for Jerome Powell. And it seems like from the Senate's end, stuff has been easing from a complications perspective. And Kevin Warsh will be coming in as the chair of the Federal Reserve on the next meeting, which is not going to happen until June. They don't really meet in May. So in 46 days from today, the Federal Reserve is going to be meeting. And given that it's going to be a new Fed, whatever they said really didn't matter. But the important thing that mattered is that Jerome Powell has decided that he's going to stay as a governor on the board, on the Open Market Committee. The norm has been that once your term ends as a chair, even if you still have a lot of years remaining in your term as a governor, just one of the 12 members, you would resign. of oil. But since he's being threatened legally, and he has immunity being on the board, he's staying on the board. So will there be a theme of we have a chair and an ex-chair for the first time in history going forward? Yes. But also those are nerdy central bankers who are not really about public stuff. So they're going to sort out their issues in private. This is the hope. The markets went up. But once, it was announced that Jerome is staying there, what happened is that interest rates on the 10-year slightly ticked up. And this is what is interesting. And usually that indicates a little bit more uncertainty. And it's usually bad for the US if interest rates go up and the dollar also goes down at the same time. This means the international community is losing their trust in the American system. Like if the US one day starts getting in a very bad debt situation, the first signs we're going to see in the markets is that 10-year interest rates are going to go up and then the dollar will plummet. And those happening together is bad. What happened on this news is that interest rates slightly ticked up. Like this is really noisy. It's not that big of a signal, but they went up, but also the US dollar went up. This acts when you have higher interest rates and a stronger dollar in terms of uncertainty, like what's happening with the oil, etc. This acts like an international vacuum. So the US becomes very attractive to every other investor outside the world. You invest in the US, you can either invest in stocks, and stocks are going to go up and the currency is going to make your return even higher. Or you can invest in bonds, which are going to give you a higher interest rates because they went up and the dollar is strengthening, so you make your money. So what happens in this situation is that the US economy starts looking like a vacuum cleaner, sucking up all money from the rest of the world, propping up the US economy. So from the perspective of the Americans, stuff are going great. Stocks are going up, bonds are strong, the dollar is getting stronger, so we can import more. It looks from the consumer's perspective like everything is going well. But from the other side of the world, other economies are now at a higher, like as of this week, are at a higher stress versus the US. And we are seeing it, like the UAE is asking for a swap line with the central bank just for them to be able to defend their currency. Japan is still in the struggle that we talked about last week with higher oil prices. So what we're seeing is that this higher import cost on all countries related to oil, the higher oil costs that are going to strain economies across the world, is hitting countries unevenly. And the US is probably the one that is most immune from this impact. So if oil prices stay as high, there is a risk of a recession. But if they stay high and everyone is able to absorb it, it means that inflation is going to stay sticky. And we are in between these two. So remember soft landing versus recession that we talked about like 3 years ago? It might be happening back, but more for the rest of the world versus the US. And this is where we stand as of now.
Jake, it looked like you had something there.
Yeah, Rabih, my thought is, like, for the listeners of this show, do we just sound like a broken record each week saying, you know what, despite X thing that happened in the economy, despite this, despite that, the American economy just continues to chug along and be awesome?
Does feel that
like,
way.
What's going to derail this? It is crazy. Like, we're getting wars and oil prices and
tariffs
and all these things. And maybe we have a short term, like people get scared, the stock market goes down, followed by a swift recovery. I'm always just amazed. Like, it feels like we've been doing this for a few years now of waiting for the shoe to drop, waiting for the economy to turn sour. And it just doesn't.
Yeah.
But
so more specific to that, I'm going to build on that really quick, Jake, because more specific to that than building on that is, you're saying the U.S. seems to be insulated from all these issues, the latest one being oil and this war with Iran. But what specifically would it take to derail this, as Jake is saying, specific to like other parts of the world? Like what other part of the world, like maybe it's China, which is ironic because a lot of this is motivated, I think, to hurt China, I believe, is what we've talked about. What part of the world can be hurt so bad that it would actually eventually have a ripple effect of hurting the U.S.? Or does it not? Because the U.S. has kind of taken this isolationist approach over the last several years, and we're relatively energy independent, for example. Like what could derail this, to Jake's point, but specific to like other regions of the world getting hurt and have that rippling over to the U.S.? Is that even a thing?
You guys are thinking in the right direction. Like, we don't think if something is going to break, it's going to break from within the US. It's going to happen outside and it's going to ripple into the US. Well, in such situation for foreign countries, when they are oil importers, the US dollar is going up, as we just mentioned, and oil is getting more expensive. So it's a double taxation on them, how expensive it is to import their oil. That will slow down the economy. Unlike developed countries where, the government has a lot of tools to work with, the consumer has deeper pocket and they can handle fluctuations, citizens in other countries are in a less robust situation. And usually when an economic hardship shows up, they are more impacted. This usually leads to faster defaults, political instability, and in the case of countries, debt crises. So if there is going to be, yes, there may be some strikes, or there are some people going on the streets, I don't know where, in Iraq or in the Gulf countries, or people in Japan are being pissed off, or India, turbulence, whatever might happen. It has to be big enough that these countries themselves start having issues with the international monetary community, aka they go into insolvency with their debt, they default on their debts. Think of Greece. We are still very far away from that, right? The only one that's prominent right now is that the UAE, because they can't really export their oil as much because the Strait of Hormuz is blocked. They don't, when they sell their oil, they get US dollars, and they use that US dollar to maintain the peg of the UAE dirham to the US dollar. Well, since they don't have US dollars, how will they maintain the currency peg? They're asking for a line of credit from the central bank. If these stuff start showing up, we'd start seeing currency, packet currency broken, or economic or political instability, in extreme cases would lead to that default. These are the stuff right now, external, that would ripple into the US, but I would give them a 1/10. Like, we're going really into the tangent here, trying to see what might break outside the US that might affect us. I think the market is bullish, and the others, not on rational basis, but it's bullish. A new Fed regime is coming in. That Fed wants lower interest rates. U.S. consumer is still able to spend. The impact of the higher oil prices showed that the global economy is more robust than we thought. The signs of positivity are larger than the negativity. But as you guys, we've talked about it many times on the podcast, the economic system can become more and more and more vulnerable, but it does not break until something external happens. And those external stuff are unpredicted. So for us to be on this podcast trying to figure out whether the next COVID is going to happen, or maybe tomorrow something happens, and the impact will be so huge that would impact us, just because we are now in a more vulnerable position than we were a couple of years ago.
Yeah, famous last words, right? We're all saying, oh, no, things are positive, and then something is going to break and happen. It is just interesting. I think a lot of people share the same sentiment as us, like some external factor will happen and that can cause things to start breaking. But it feels like, right, oh yeah, there was a war with Iran. That's the external factor. Or tariffs, that's the external factor. Like, we're looking for the external factor, and all of these are kind of coming up and not really getting the job done for the people. I just find it interesting.
And I would call this crew, this trifecta right here, maybe the prediction posse. So if anyone's going to predict anything,
we got it.
I think it would be us.
Guys, right? S&P 500 is up 6% to the year. Are you ready to make the predictions, both of you?
I said a few weeks ago that I thought we'd end a little flat or even slightly negative. I'm looking dead wrong on that right now. It's like it's another 4 year in a row so far. We all know the data around all-time highs and how often that momentum then carries. So I'm not ready to change anything, but it's starting to feel more positive now. Jake?
Yeah, I'm still pretty stumped. If I had to guess, right? If I had to guess, I would say we end the year, which is what? We have 7 months left this year. No, 8 months left. I think we end about where we are. 6 to 8% up on the year feels right to me.
Yeah.
Maybe we kind of just have some up and downs and end up flat the rest of the year. I have no clue, but that'd be my guess.
If you're playing probability, that would be the safe bet, just based on two things: the momentum built around all-time highs and what that usually does, and then also just the fact that every single year, on average, you see about a 55 to 60% chance of being positive.
Yeah.
So I think you're probably right, and we tend to nail predictions with this prediction posse here.
Yeah.
Also, just a quick observation. One thing I'd say is one person who doesn't believe in retirement, based on what you were saying, Rabih, that Jerome Powell's going to stay as part of the committee. He's 73. This guy just, doesn't believe in retirement. Neither does Trump. And a lot of these guys
Does
don't.
anyone? That's like the thing.
Does anyone believe in retirement?
I think this is a theme across, like, if you look at different industries or sectors, these guys who are very successful are reaching their mid 60s or mid 70s. They're like, why am I just going to go sit on the beach? That's not very fun. This is interesting and I have some power and influence. And why would I leave the spotlight? It's an interesting, I don't know if it's a phenomenon or maybe we're just learning this about human nature, but because I don't think elder generations have had this opportunity in the past, maybe. Yeah, these guys just wanting to stay around longer. Jerome Powell's like, no, I'm not leaving. I'm just going to keep staying here.
I think at a certain level of success, it's like, what else? I think these guys probably think like, what else would I do with my life? Like, this is what I do. This is my identity. Rabih, what do you think?
I'm just going to defend Jerome Powell for a second.
Of course you are.
And say that I just think he doesn't want to go to jail.
That might be
He's trying to wait the Trump term out while he has immunity.
Oh, that's a good point. It's just, he wants to go retire to Tahiti or something, but he can't until Trump's gone. It's interesting. Okay. Anything else, Rabih or Jake, on this? Okay. Let's jump to the next two. They're really related, but let's start with you, Jake. Are you living paycheck to paycheck?
Yeah.
That's a rhetorical question. I'm not asking you that, Jake. I know you're not living paycheck to paycheck, but hit us with this data.
I'm going to share my screen here for the people watching on YouTube. And
like and subscribe.
There we go. See if we can get. Here we go. Can you guys see this?
Can you see my screen?
Can you see my screen?
Yes.
Okay, so this was floating around on LinkedIn, I think the past couple of days, this chart. Daniel Crosby is the one that I actually, he shared this. Daniel Crosby, friend of the podcast. Again, he's coming to our summit and we'll be speaking there. Show up. It's going to be awesome. But he shared a graph. It was from a study from GS. Not super familiar with them, but in 2025. And they surveyed people at all different income points. You can see on the graph here, less than 5,000 people making less than $50,000 a year, all the way up to people making 500,000 more and beyond per year.
Wait, is GS Goldman Sachs?
It might. Okay. Okay. There we go. Thanks for the clarification. Goldman Sachs is probably where this data is coming from. And they just asked people, okay, at each of these different income levels, are you living paycheck to paycheck? Are you moderately, like these categories are a bit interesting, but the first one is, are you living paycheck to paycheck? The kind of blue middle one, moderately better, is like, are you moderately achieving your financial goals? And then this pink one is like, are you considerably saving towards your financial goals? And the shocking thing, which I think this got some traction on LinkedIn, or at least my side of LinkedIn with financial topics and things, is if you look at this far right column here, it shows that people making $500,000 plus a year, of them, 40% are living paycheck to paycheck.
It's wild.
Which I think is stunning for a lot of people. I mean, these are, if you're making $500,000+ a year, you are like in the top 0.5% of income earners in America. And we're saying like 40% of those people are living paycheck to paycheck. Thoughts on this? Initial reactions from you guys, if you have any.
Super interesting. I think what's interesting to me is this massive increase around that a massive increase in what people are saying they're considerably better, and a massive drop in living paycheck to paycheck from the less than 50,000 down, and then it goes down when it goes to 50 to 100, and then down again from 100 to 200. Only 16% of people say they're living paycheck to paycheck when they're making between 200 and 300, and then it significantly jumps.
Yeah.
Back to 41% above 300,000 and then stays there above 500. That's the first thing I notice is, and I think that's worth like thinking about, like where is that difference of like, you're now making over 300 and all of a sudden you're back to living, like that seems to be the lifestyle jump right there.
Yeah, it's interesting where, according to this graph and this survey, the most kind of successful people from a savings point of view are the people making $200,000 to $300,000 a year. Right? Kind of that is like the sweet spot of, I'm saving a lot of my money, hardly anything, I'm living a paycheck to paycheck. It goes down up until that income level, the paycheck to paycheck people, but then it spikes up, beyond that $300,000 range. Is interesting. One thing I wanted to bring up kind of with this and just talking through it is the more money you make, you actually have a bigger responsibility to save. And we talk about this all the time with our financial independence and retirement numbers, right? So I wanted to go through a few things. Let's say you are someone making $500,000 a year and you're living paycheck to paycheck. So $500,000 a year income, if you live in a typical state with not crazy state taxes, I'm not talking about you California and New York people, but just like normal state taxes after you pay federal, state, and FICA taxes at $500,000 of income for a married filing jointly household, you're paying about $140,000 in taxes.
Oh, still hurts. That
right?
hurts.
So yeah, about 140. I know it's never fun to see that dollar amount split out like that way. So you really have at $500,000 of gross income, you're taking home like $360. Right? It's kind of your take home pay after taxes. So if you are living paycheck to paycheck, you are spending all of that. Let's say, right, that entire $360,000 per year using if you need about 25 times your annual spending in assets to be able to retire or to stop working or make work optional, that would put that number right at $9 million is what you would need, right? At $360,000.
Because you're saying that person's spending $30,000 a month.
Yes, right? Because it's after taxes, they're spending the rest. Right?
Yep.
It's just all going away there. And so you need $9 million at that spending level. What's interesting is, because that's like obviously a bigger number there. For the average American spending is around $6,000 a month, right? We don't need to dive deep into that number, but about $6,000 a month. So for the average American at 25 times their annual spending, they need about $1.8 million to retire.
Isn't that crazy?
Yeah, right. It's like 1.8 versus 9 million based on these spending differences. So I was thinking about it's actually like if you are going to live paycheck to paycheck, it's actually better to do so at a lower income level, if that makes sense, weirdly enough. Like someone who is spending $6,000 a month and maybe making, $70,000, $80,000 a year is closer to retirement than someone making $500,000 a year and living paycheck to paycheck. Because they only need 1.8 versus this person not saving anything needs 9 million. I just thought that interesting of like that line of the more money you make, you actually have a bigger responsibility to save because of your lifestyle and the things there. Or like someone, average American, they can do some money to their 401k, Social Security will cover a lot of it. They can kind of fit, like if you're a paycheck to paycheck person at $80,000 of income, you can kind of finagle some sort of retirement for you. But these people at $500,000 plus in income, paycheck to paycheck, there's such an uphill climb there, which I thought was interesting.
Absolutely. Rabih, let's get you in here.
And I have thoughts. Before I get into like the statistics, like the numbers, something that I noticed is that we're seeing at the graph and assuming the bars are equal, but the problem that leads to this, categorization is different. For people who are making less than 50K, their main hurdle in life is income. Whereas those who are making over 300,000 and $300,000 in a year, their main hurdle is liquidity. It's not like you're making 300K if you properly allocate or match the cash flows or properly manage the liquidity to act as a treasury department. You should not really feel the stress of a 300K. If you're making 300K, any bank out there is willing to extend you a line of credit for you do not feel that I need my paycheck to come or else I'm going to default on my payments. It's a liquidity problem. That is the first thing that comes to mind. So, and as Jake said, like the solution for those are different than the others, and it might be a hurdle to get or a steep way to get out of it. The second thing I would think of, and this is me just putting my professor hat on for a second, excuse me.
I was going to say, what are you, a stats professor or something?
I am a stats professor. So what I would think of is like, okay, we've got these 6 bars. How many respondents fall into each of these bars? Did we get like 1,000 people in the under 50K answering, and then we had 200 only answering in the 500 plus? Also, how did they collect the data? Who is making over $500,000 and is sitting and filling a survey online for Goldman Sachs? Like, I really would, I'm not saying they're collecting their data incorrectly, but this is such a wide cohort of people to collect data from, different lifestyles, different way to approach them, at different biases. I would want disclosures. I'm not saying they're doing a bad job, but I would want disclosures just so I can make sure that I'm not getting fooled by the numbers in front of me.
Can I talk about that point, Rabih, actually, because that's perfect. I did want to bring this up, actually. This is kind of like a secondary point of like no matter how much money you're making, if you have a spending issue, you're not getting any closer to retirement, right? The second point I wanted to make with this actually is we need to make sure we're investigating all the surveys and where we get our data from, right? So like LinkedIn, this is kind of doing the rounds on LinkedIn. I saw on the survey, so they asked respondents, if you're living paycheck to paycheck, their description of that was, I find it tough to make progress on any long-term financial goals, was their description of paycheck to paycheck. I don't really think so. People, like the respondents could have answered that or thought about that in a myriad of ways. Or like, I wonder if these people, like these $500,000 plus income earners who were responding to the survey, if they were like, oh, like I'm not really making long-term progress. I'm like, maybe like their long-term goals were $15 million in liquid assets. And they're like,
Yep.
I don't feel like I'm getting close to there, but they are maxing out a 401k, doing other things, but they just feel like they're living paycheck to paycheck, but they aren't really living paycheck to paycheck. And so that's awesome, Rabih. I wanted to bring that up of a lot of these surveys that like make our blood boil or kind of we make assumptions off of. There could be a lot of like vagueness going on in how they ask these questions and the people responding.
It's a good point, Jake. And I think too, we've seen this. I've seen this in my personal life talking to people. I've seen this certainly with dentists who will say they're living paycheck to paycheck and they're counting savings as part of their spending number. So they'll be like, well, I feel like I'm living paycheck to paycheck because I don't have anything left over in my checking account, or I have very little in my checking account at the end of the month. It's like, we look and it's like, you just saved $10,000. It's like, well, yeah, but I'm not spending that.
And I have a vacation home that I'm paying for too.
Yeah, exactly. So I totally agree that we need to make sure we're being thoughtful about the nuance around these types of surveys. And oftentimes they fit more the clickbait than they do like the efficacy of like an actual study, like a double blind type study. But the other thing I wanted to mention, Rabih, to point something you said, that people under $50,000 in income they have an income problem, which is so true. If you are making over $500,000 and above, and you're truly living paycheck to paycheck, you have an ego problem. You don't have like, that's not an income problem. It's not a liquidity. I mean, it is a liquidity problem for sure. It's an ego problem. Like that's the origins of your issue. Morgan Housel says the difference between your savings and your income, or what does he say? Between your spending and your savings is ego. That gap is your ego. And I think that is, if you're making that much money and you can't save, you have an ego problem. And I'm not saying that to trigger anybody individually.
I'm triggered, Matt. I'm so
sorry.
triggered.
I'm sorry. I know you're making a lot of money and you're living paycheck to paycheck. So I'm really, really sorry.
Yeah, it's just one of those things at that income level. You're a top 1% earner in America. Yeah. So it's like, if you can't find a way to live paycheck to paycheck, what do you think everyone else is doing? The 99%. It's not an income issue at that point.
Yeah, for sure. Anything else? This is really good. And this is going to lead into the final. This kind of just blends into what we're talking about, this final topic of how much do you actually need to save. And this is a much bigger conversation probably for the main show, and dedicating. In fact, Jake, we're going to do an episode on this next week, and we'll probably bring this back up for the main show. But I had an interesting conversation with a client just recently. He was asking about savings, and our guideline, we tell people around 20% savings being the goal. And he has a unique situation. He's younger, very, very high income. He's not living paycheck to paycheck, but he's built up a ton of assets for he's well ahead of most people for his age. And his question has constantly kind of been over the last really year or so, 2 years, has been like, do I really need to keep saving 20% into my accounts? He's got multi-location practice, doing a ton of money or doing a ton of income. And he's not saying he wants to stop necessarily. He's just saying, do I really need to keep doing that? Or what I've built up, can I let that kind of just coast? And then I can start spending more or putting more money, maybe do another location or whatever. He was asking about the nuance of kind of our goals or our guidelines around 20% savings. I'll leave it there and just get your guys' initial thoughts or response around when we say 20% savings. What do we mean by that, and where might there be some wiggle room or nuance to that?
Rabih, do you want to go first?
Yeah, I'm gonna channel in our own Taylor Sutherfield when he says, general advice is not good advice. 20% rule is the epitome of the rule of thumb in investing and in saving, right? Yep. And for each person is different. I'm single. I don't save 20%. I save more than that because I don't have the responsibility of spending on a family. I'm not starting a practice. I don't have kids. Whereas someone else early in their life where they just invested in a practice, there's no way they're saving 20%, but they are setting themselves up to be able to save 20% later in the future. So when you said nuances, I'm like, yes, let's look at the specific case and determine what's the optimal savings rate there, right?
Yeah, I love it. Jake?
Yeah, there is a point with saving. We say 20% because that's a great, again, aggressive savings number, right? To throw out some averages, I talked about this all the time. The national average savings rate in America usually, goes from like 3 to 4%, hovers around there. The median savings rate is 0. However, like that average savings rate is bought up by the big earners, the middle person in America doesn't save anything. It's really hard to save, but we encourage the people that we work with to save, 15 to 20% is really where you should be at. However, like for this person you're talking with, Matt, there can come a point, which is the cool thing about saving and investing, especially early on. You can build up enough assets in your life where you can get to a point where we call like coast fire is a thing. And I
Yep.
think you mentioned that coast word, right? Like there's the
Yep.
fire movement of financial independence, retire early, people just stopping. That's one version. There's another version called coast fire, which is I built up enough assets by the time I'm 40, 45, whatever age may be, where if I don't contribute an extra penny to my investment accounts and savings accounts, the market will just, the growth over the next 20 years will get me to my retirement number. Like I
Yep.
actually don't need to add anything additionally just because I've done the heavy lifting early on and compound interest is going to take care of the rest. And that can be a thing if you're like, hey, I am actually at this point where I've built up enough assets. I don't see my lifestyle expanding or increasing all that much more. I don't want anything more than I currently have. I'm fine taking some of this money and bringing down my savings rate, going on a few more vacations, buying some nicer wines, whatever it
Yep.
may be for you. You can reach that point, which is pretty cool.
I think it's actually an ideal situation for dentists in a lot of cases, and we see this all the time. And this is the nuance I want to highlight: is when we say 20% savings rate. To Robbie's point, that is truly the general guideline. The nuance here is what you're hitting on, Jake, and we see this in real life all the time. There is a phase in most people's lives when they have kids and a family, which most dentists we work with do. That in that like high school, early high school through high school, and even a little bit after high school, it's like this phase of life that most dentists get to, where they're like, I want to do more with my kids. Like you start to feel that kind of like, this is it. My kids are
They're
gonna
gone in 5
they're
years.
gone. Yeah. My siblings are dealing with this right now. I've got some friends dealing with this right now. I've got younger kids, Jake, as you do too. But I can totally see that of like, you know what? I want to cut back a little. I want to spend a lot more, go on these bigger vacations because I don't get this time back in my life. And I've seen this time and time and time again that phase of life is the ultimate. I'm not getting this back. Obviously, every phase of life, by definition, you're not getting it back. But that one feels the most pressure filled for a lot of people. So to your point, Jake, I've seen this and dentists are set up so perfectly for this. And this is the nuance. Maybe early on, you just don't have the cash flow to save 20%. That's okay. Do what you can, build up what you can. Maybe that phase of life is you're getting to a place of like, okay, now I'm reaching 20%, but now I'm in this like can't get back phase of my kids and I want to go do these big trips. I'm going to cut back to 5, 10% or less during this phase. And I'm going to go just like blow our money on these trips. But then once my kids are gone, I'm going to then get back to now debt's paid off. Kids are gone. I'm now focused at work for the latter part of the last 15, 20 years of my career. I'm going to be saving 30%.
Yeah.
That kind of stuff happens all the time. And so I guess the main thing there is being the nuance of don't put too much pressure on yourself to be like, I have to hit 20% every year, no matter what, to reach my goals. Like in most cases, that's not going to happen in real life. Some years it's going to be more, some years it's going to be less. Give yourself some grace and realize that every specific situation is different.
Yeah. I mean, the cool thing there is for your client you were talking to, is if you can save and do the heavy lifting early on in your career really does help, which is we always say it all the time, invest early and often. That gives you more flexibility down the road. And this also requires nuance too of what type of lifestyle do you want to live in the future? It's like, can I cut back my savings or do I want to have a more expensive or lavish retirement or extra money to help kids with down payments on houses? Or, it depends on your financial goals and things you want down the road too. Can you cut back your savings? Can you not? But yeah, there's that savings rate. I like viewing it as a variable thing where there's no ironclad rule. We have to put away 20% every single year, every single month. It can change and move up and down as your life changes.
Totally. And just so you know, for context for this person in particular, I've run the numbers for him. If he just continued doing what he's doing and saved no extra money, which is not going to be the case throughout his whole rest of his life, he would have somewhere in the ballpark of $13 to $14 million in his overall portfolio because he's done such a good job early on. So he's got some wiggle room there. That's outside of his businesses, by the way, and real estate. So he's going to be okay if he just continues to do what he's doing. Now there's a difference between saying I'm no longer saving versus I'm going to start dipping into this now. Obviously very, very different.
And that can manifest itself too with the dentist is It's like, okay, maybe I don't need this 20% savings rate. I only need to do 10%, or like I still want to do 5 to 10, which we would always recommend. I think it's nice to just have the habit of
Have
always
the
putting away
habit.
something. Maybe it's a 401k or something
Yep.
you're always maintaining, but that can manifest itself in, okay, well, maybe I can go from 4 days down to 3, right? Because I don't need to be saving this extra X amount per year. I can chop off one of my days of working and reduce my income by a little bit, and I'm still okay there.
Yep. Rabih, any final words on this?
No, I love it. And it seems like people start with that savings rate and then see, okay, what type of life will I get at that savings rate, right? Oh, you're telling me 20, where would that lead? This is not our approach. You guys just went, for a couple of minutes, really explaining this well. You decide on the life you want and you squeeze out what savings rate do I need to be able to match and make that life a reality. And that's why it's personal. Decide on the life, you will know how much you need to save.
Dare I say, do it on your terms?
Let's go.
Oh,
Dare I say, which is the theme of our summit coming up in June. Would love to have you. Midway, Utah, June 11th through the 13th. Come meet the team. Come hang out with like-minded dentists. It's getting full, guys. We were just looking at the numbers, super pumped about this group and really, really excited about the speakers this year. Rabih always gets bashful when I bring him up, but he is speaking this year. But we have other speakers this year around leadership. We got a lot of feedback around, hey, we want more leadership type topics. So we're going to talk about leadership and leading your team on your terms. We're going to talk about uncertainty from Pascal Fignette. We're going to talk, we have Dr. Daniel Crosby talking again. Really, really cool group. So we'd love to have you. The theme being practice on your terms. It's a lot of what we just discussed, to your point, Rabih. So June 11th to the 13th, dentistmoneysummit.com. Any final words of wisdom, Jake or Rabih, for the good people?
No.
We're just kind of like, we've exhausted our wisdom for this Friday.
Have fun out there. Enjoy your weekend.
Enjoy
Life's
your weekend.
great.
Yeah, exactly. So everyone, thank you so much for listening. As always, Rabih and Jake, thanks for sharing your words of wisdom. That was our 2 cents. Till next time, have a great weekend. Bye-bye.